Now let's take you to the Mövenpick Ambassador Hotel. It's where we're having the Joy Business Knowledge Series just happening now. And the core of the series is to demystify taxation in Ghana and how SMEs can be better at tax compliance and how also it impacts on good business practices.
George Kwitia. George, if you give them a wave. Mr. Abekuja Nkwansa and Mr. Kingsley Owusu Ewuli is present. Okay. I also have a team of individuals who are tax experts, and they are in the audience wearing name badges which also indicate their area of specialization for taxes. So please feel free to speak to them during the networking session at the end of this event. So without further ado, I'd like to hand back over to Inshira Ado to take us through the next stage of the event. Thank you and good morning once again.
Thank you very much, Aisha. And just before I go on to introduce the next speaker, I'd like to encourage all who are listening to us and watching us on JoyNews TV and on Joy FM to use the hashtag IntelliTax to communicate, spread the word. More importantly, send your questions through and we will get you some answers from our tax experts who are here with us. Our next item is a presentation by Mr. G. Jeje Fiajo with PwC. Ladies and gentlemen, let's welcome him with a round of applause.
Thank you, Inshira. Can I detach this? Okay, I think so. So I'm just going to spend some time talking today. I'm sure you saw how Inshira had to struggle with my name a little bit. I come from that part of the Volta region, the southern part, where we actually pride ourselves in the fact that our names are very powerful. We can actually have an English translation of almost every name that we give our children. But come to think of it, we can only do that for our first names, but our surnames usually will have a story, and mine has a story. The name you see up on the board there, Kodo, is my mother's maiden name. It has a story. But the story I want to tell you today is about a man named John Kodo. John happens to be my uncle. Uncle John, we call him most of the time. And he has a unique business story. John was a very gifted person. Well, he is, because he's still alive. He trained as a lawyer and worked for a bank right here in Ghana. While he was working, he thought that business is a thing to start. So in 2003, he started selling brand new shoes to his own colleagues. Well, John goes on with this business for 10 years, and he managed to grow 3 business lines. He's into selling and distribution. He is then as well into cleaning services, and he started something he likes to call construction. Well, it did not end there. By 2018, Uncle John had to retire from being a banker, and then he decided then to call himself the CEO of a conglomerate. He's into selling and distribution, of course, continued his 3 businesses, turned the construction into real estate, started getting into all the space lettings, and then as well, partnership stores, we call them. And then he started venturing into transportation. But why is his story so unique? He only had a knack for business. His turnover, he has told me not to mention, so I'm not going to mention that. But he had registered 9 businesses in 15 years. He went on ahead, having employed people. Now he is having 87 workers. And for an accountant, I did look at his books. Uncle John's books were perfect. He kept every record. I didn't drill to the source document, but hey, he did very well at it. After all, he worked for a financial institution. His control was just remarkable. I wondered how he did it. I wondered how he looked at everything. He kept all assets in his name. He used his personal property. I remember that he had to relocate his family once or twice because he needed to use the buildings that he had. He drafted most contracts himself. He's a lawyer after all. And by the time he was retiring, 6 of his entities actually were not really operational. I want to call them that they were quiet. Well, he had something he said, which is why he called me in. He said to me that, you know what, this is business. You cannot always cut corners. Once or twice, yes, you can. But once you make that big sale, Uncle John will say to you, settle everybody. Just go settle them. And that was how he approached everything that he did, including legal and taxation. What made him very good for business? Uncle John was a likable person. He teamed up with anyone. You were always surprised who he was able to work with. Uncle John worked with port handlers. He even integrated cleaning businesses into his own business. And that was so remarkable. Carpenters, masons, anybody, plumbers, he worked with them all the same. Sometimes they were partners, sometimes they were business colleagues. But Uncle John called me in because he was cash-strapped. And he says, my son, your father tells me that you're an accountant and a tax practitioner. Well, this is what happened. After December, I could not pay anything else. People tell me that it's because of the VAT changes that were introduced. I don't know. But tell me what you know. So, thankfully, for the first time in a long time, I get to be a consultant for my own uncle. So as a consultant, you walk in and you say, Uncle John, you know what your problem is? I've looked at your records. Okay, so here we go in the consultant's voice. Here are facts. You have 87 workers. They are all on payroll. You never bothered to collect your duty receipts, Uncle John. Well, that's fine. All cars are personal assets. And then you paid your business partners and made sure that the withholding taxes were paid. Uncle John, you've done so well. But I noticed as well that you maintained cost in one structure, but you recorded everything fine. Uncle John said, okay, what are you saying? I said, Uncle John, you did well. You made all the right decisions that anyone could make. You paid your PAYE, you paid your SNIT, you recovered VAT through pricing, you increased your prices so that your customers can pay you. Uncle John, I'm fine. You didn't make claims because the vehicles are in your name anyway. You paid all your withholding taxes, Uncle John. You are okay. You continue to do business and pay taxes just the right way. But Uncle John, have you thought of it? Perhaps those decisions could have been smarter. Not all your workers are actually your employees. Some were actually service providers to you. Some were even casual, but you put them on a payroll all the same. You ignored your input claims. You made cars your personal assets because you wanted to sell them. But here goes. You used all of them for business. Uncle John, these partners that you call them, are they service providers or are they your partners who should enjoy dividends? Perhaps these are the questions that he did not answer. But I didn't leave it there. You know what we do as consultants? We actually then shove our hands into one pocket and then we say to ourselves, okay, now the final one. Uncle John, I think you need company. You could tell the look in his eyes. He says, okay, excuse me, what are you saying? I mean, Uncle John, you need a company on top of all your businesses. It's the one thing that you didn't have that seemed to cause a lot of tax leakages. I shared this story, partly a personal story. It is a story of many entrepreneurs, some sitting in this room, some out there. is a story that most people have. It's a story that tells a bit of what others may have because they started somewhere right from the middle or they were handed over a business. But the real question is, how do we handle our taxes? Before I could walk away from Uncle John, I thought the best thing to say to him is that, Uncle John, you know what? Tax is business. Same way you make your business decisions, you must manage it intelligently. Thank you.
Can we do a better round of applause for Mr. Jijeje Fiajo? I think I did a better job the second time around, eh? I've been practicing all morning, and then just before I said his name, I looked his way, and then I froze. So if you practice someone's name, if you have to say it, don't look their way, and you probably will just be fine. Next up is a very important panel discussion. We're going to run through that, and then we'll open the floor for all our Q&As. Help me welcome these very excellent tax experts, starting with Gifty Mate Trebi. She is the expert on employment taxes. Please, round of applause. And another Gifty, Gifty Angie, who is in charge of direct taxes. And Laura Fiagome is the expert on indirect taxes. A round of applause, please. And the senior tax partner is in charge of general and transfer pricing. Ladies and gentlemen, welcome George Kwetia. So we're going to go into a very quick conversation about taxes. And I'd like to start off with, if we can just go back quickly to Jijeje's presentation, where we see all of Uncle John's stuff, where we see the businesses he has, the employees, and everything else. I think therein lies a challenge for lots of people. You see in there the direct tax implications, you see in there the employee taxation, you see in there the transfer pricing stuff, you also see the indirect taxation elements in there. From your estimation, I would like to start with the indirect taxes because quite often these are things that we don't pay too much attention to because it doesn't hit us immediately. Why should businesses, or why is it important to understand indirect taxation, and how do you mitigate against suffering the kind of situation that Uncle John did in the end?
Okay, so Insha, you're very right. For a lot of entrepreneurs, when they're going to start business, of course, everybody thinks about direct taxes because it's what hits your income. You feel it directly, and so that's where the focus is. Mm-hmm. And most people tend to forget about indirect taxes until it comes back to bite them. So as a business, yes, you need to think about indirect taxes. One of the reasons why you should do that, if you recall in Jijeje's presentation, he was talking about Uncle John passing on, recovering his VAT through his pricing mechanisms. But the question is, if he had thought about indirect taxes properly, could he have registered if he was eligible to register? Could he have done that? Could he have recovered some of the VAT and so that his prices would not have been affected? Could he maybe have made more sales because his prices would not have been as high if he were recovering VAT through the proper means? So these are the considerations that you should have as a business, because it's really sad when there's an audit and the tax authority comes in and they tell you that, hey, you meet all the markers to have registered and charged the tax, but you didn't. And so they go ahead and levy the penalties, and that can be pretty painful.
Wow. So my math is not that great, but if tax on on, I buy something and the total cost is 100 cedis, which includes tax, and I want to slap my 17.5 on there, then it's 117 cedis, 50 pesos. And that's basically what Uncle John was doing. How does that impact on, at the end of the day, he's just transferring the price to the cost, which is what we all do. If you buy X amount of products to sell at 10 Ghana cedis a pop, and your transportation costs 2 cedis, and you need a margin of a decent 3 cedis, it means you sell it for 15 cedis. Is that not a prudent way to do business?
Yes, that's a very simplistic way of looking at it. And by way of updates, the VAT rate has changed. It's now actually 12.5%. And then we have the straight levies, the NHIL, and the Get Fund levy of 2.5% each. That was just by way of update. Okay. Now, Isha, you're very right. It starts off with a cost base of 100, and you want X margin. So you slap on your margin, slap on the VAT, and then that is how much you sell your product for. But the question is, in that cost build-up of 100, could you have recovered the 12.5 in this circumstance, so that you're starting off with a cost base that is already less than the 100 GC? So you're starting off with about 87.5 as your cost base. Okay. If your margin is a percentage, then of course, then the margin is smaller, and then when you put on your taxes, it's smaller as well. So these are the benefits that you need to think about in terms of indirect taxes, rather than this is my entire cost base, I want this margin, and so this is it, and this should be the taxes that go on top of it. Okay,
so Uncle John is a very interesting man. He kept his cars, in his name, but turns out that whenever he had business for continuity, he would just, pick one in the group and say, look, let's farm it off to this one to do. George, there are issues of transfer pricing in there, and I'm pretending to sound like I know what it means. Help us appreciate how that, if unmanaged and not done intelligently, could hurt a business.
Thank you, Inshira. I think to start off with, maybe just to give some background to, and I will also relate to Uncle John's story. With transfer pricing, we're talking about dealing with related entities. Of course, Uncle John had a couple of companies, 9, even though
only 3 were working.
6 were defunct, so to speak. So we have a situation where once you have services being supplied by controlled entities which are related, then that triggers a pricing issue. We also saw from Uncle John's example that he crafted or drafted all the contracts. So actually, we also see a situation where there's an influence. And when we talk about controlled relationship, we're talking of ownership and we're talking of influence. So obviously, by his conduct and the way he's been running his business, I can foresee a situation where the cleaning services company probably was providing services to the real estate entity because he had warehouses, he had spaces to rent, and obviously, he's going to draw up a contract between the two entities for the cleaning to provide services. And once you have a relationship like that, that triggers a transfer pricing issue for you. Why would it do so? The reason being that when you have transactions between related entities, it is expected that the transactions are priced at arm's length level. When we say arm's length, what do we mean by arm's length? We mean that you put in a price which would not be influenced by your relationship, such that the pricing of your product should be about the price you would have sold out or provided the services at a price to a third party, an independent third party. If you do not do that, then the Commissioner General now looks at your books and decides to make appropriate adjustments to reflect a third-party price. And so if we take Uncle John's example, for instance, having crafted the contract, he puts the entities in an influence because he's the one dictating the price, probably. If, like the example he said, he didn't give us the details, which one is defunct, which one is active, which ones had the revenue, and which ones were keeping the expenses and therefore creating losses. You could have a situation where if he's that smart and he understands what he's doing, if the cleaning entity is a loss-making entity and the real estate is making profit, he's going to price the services of the cleaning entity such that it will come and wipe off the losses it's making and therefore reduce the income of the real estate entity. If he gets himself in a situation like that, then obviously one is going to say, okay, if the cleaning entity was providing a service to a third party, would he have priced it the same way as you have priced it between that cleaning entity and the real estate entity? And obviously, if it is not that, then the commissioner is now going to make adjustments to, one, to eliminate the profits you've created in the cleaning entity, and also reduce the costs, the high costs you've created in the real estate entity. So if you don't manage it well, you're likely to lose on both ends when the Commissioner General does any adjustment as far as transfer pricing is concerned.
If you just tuned into Joy 99.7 FM, you're listening to IntelliTax. It's the first in the series of the Joy Business Knowledge Series powered by PwC. And we're live on the JoyNews channel on the multi-TV platform as well as on DSTV channel 421. And if you want to join the conversation remotely, just text. You can actually use the hashtag IntelliTax and tweet at us, and we'll be very happy to field your questions. Let's leave Uncle John for a moment and let's jump into direct taxes. That's corporate income tax falls in that area. So, Gifty, what's your view on the corporate tax regime as we have it on SMEs?
Okay, thank you, Insha. So on SMEs, if we look at our current laws as they are, we don't have a special regime per se that put together that addresses the broad category of every single entity you would call an SME. So if I'm right, I would assume that everybody in this room calls themselves an SME. That's why you're here, hopefully. But we don't have one regime that would cover every single person as how you calculate your taxes from that line. But we have some pockets of provisions or some regime for special types of entities that can easily fall under the category. So that's a lot more narrow than the general broad category of SME entities that you may think about. And one that I can think of is what we call the modified taxation or the presumptive tax. And what that means is that it sets some criteria where it tells you that if you earn less than 200,000 Ghana cedi in the year, and then if all your income is sourced from Ghana, among other conditions, then it is telling you that you can pay taxes at 3% on your revenues. Now, what does that seek to achieve is that the normal company, the entities that are outside that regime, would go through the rigor of computing the taxes is a lot more complicated process. You have to look at the kinds of income that are subject to taxes versus the kind of deductions or purchases that they will allow you as a deduction. And there are a lot of complications around that. So the modified taxation actually simplifies the process for you and hopefully is supposed to encourage more compliance. So hopefully those of us in this room, we go back and see if there's any room at all or opportunity to take advantage of that process so that that can help you as an SME. The other one I can think of is something that the government introduced not too long ago. We call it the Young Entrepreneur Regime, where it's targeting people who are more than 35 years of age. And hopefully, at that point in the nation, we are hoping that people will be innovative as early as possible in their lives. So if you are at that age and you set up a business, that business income is exempt from taxes for 5 years. The only thing about it is that it's actually reserved for some particular kind of businesses. And that is talking about more strategic investments. We are talking about, for example, ICT, manufacturing, agro-processing, tourism. So it's also very narrow. But what we pick up from this is that these two regimes were not existing pre-2016. So it's a good place to start. It doesn't cover all SMEs, but I think it's a good place to start. Now, the encouragement is that this is actually in the law, but we are not taking full advantage of it as a nation. So hopefully, it's something we can think about so that if you qualify, you can take advantage and have a lot more compliance or less burdensome compliance and then pay less taxes.
Okay. Thanks very much, Gifty. I'd like to look a little into the employee taxes, because everyone likes a little bit more money in their pocket. Quite remember that sometime last year there was a review of the tax bands, went up and then came down again. But which kind of, or what are my options if I'm running a business and I have to, of course, pay the PAYE? What are the obligations that an employer would have that easily misses or flouts, in your experience, the rules governing employee taxation?
Right. Thank you, Inshira, for the question. And as you rightly set the premise of employment taxes are very important because we are all interested in our salaries. Mm-hmm. And at the end of the month, we all look forward to going to the bank to draw our checks. Yeah, the employer is responsible for almost everything relating to employee taxes. And that is where, as SMEs, we have to be very focused on because the potential to miss some aspects of the compliance requirement is very high. And the painful aspect is that as soon as you miss anything you are required to do, the penalty falls back on the employer. The revenue authorities do not even look beyond the employer to target the employees. Yeah, so I must start with the tendency for employers to treat non-payroll items as non-taxable items. Mm. And what do I mean by this? So an employer calls an employee and says, you've done very well, so receive this 1,000 Ghana cedis as your bonus for bringing in that extra work. That is off payroll. The tendency is for the amount not to be taxed. But this is not the case. Unless the law specifically exempts a payment or a benefit, it is taxable. So the fact that it has not gone through payroll does not mean that it is exempt from tax, and it is an area that the GRA auditor will be very interested in and impose and apply penalties. The second option, or the second issue that employers miss most is on the filing requirements. So employers are required to file monthly returns and pay the PAYE taxes. I think these employers are very good at and do most of the time. However, it doesn't end there. At the end of the year, the employer is supposed to file what we call an employer tax return. And this is supposed to consolidate all the payments that have been made to the employees throughout the year. This filing is supposed to be done by the end of April, after the year end, which is December. However, from experience, we have noticed that most employers miss this requirement and are imposed with penalties by the GRA. So those are the two key areas that we want them to focus on.
So if I'm going to get a bonus for doing well, that bonus shouldn't just be giving. So if, say, I get a bonus of 1,000 cedis for doing well, the tax applicable to that has to be deducted, else it becomes the employer's liability.
Absolutely. Yes, the employer has the responsibility, the absolute responsibility for withholding the appropriate taxes from that payment that the employer is making to the employee, whether off payroll or on payroll. Mm. And failure to do that, the employer becomes responsible for the tax itself, plus penalties and potential interest, which are punitive.
All right, let me go to Laura now. And Laura, I'd like your thoughts on, so hitherto we had the VAT service and we had the IRS before they came together as GRA. Now, are there specific businesses that should register for VAT and some that shouldn't?
Okay, so whether or not a business should register for VAT depends mainly, generally, on two things. What the business does and how much the business makes. That's what it comes to generally. So when we talk about what the business does, we are talking about product. What good, what service does your business supply? That's the first question. The general rule in VAT is that every good, every service is subject to VAT unless the law specifically says that that good or that service is not subject to VAT. So that's the very first item on the checklist. What do you do? Is it on the exempt list? If it is not, then that's one tick mark right there. The next question is, how much do you make? And this is in terms of turnover, not profit, your revenues. So the current threshold is actually 200,000 over a 12-month period, or a quarterly equivalent of 50,000. And then if you expect to make cumulatively by the end of 12 months after that period, the 200,000 and beyond, then that's your second tick mark. And so you need to register. That's the general rule for compulsory registration. So what I'm saying is, let's say somebody who does medical services, okay. Medical service, we all agree, is a service. That's what your business does. The question is it on the exempt list? In the case of our law, yes, it is. Because you haven't checked out that first mark, it doesn't matter whether you make 1 million Ghana cedis a day. You don't have to register for VAT. This is the general rule. Of course, there are exceptions for other types of businesses, like if you're an auctioneer or a promoter of public entertainment, then you have slightly different rules. But these are the general rules. Aside these rules as well, businesses can decide to register voluntarily, but that's really dependent on meeting certain conditions and at the Commissioner General's discretion. So this is the general rule when it comes to who should register and charge the tax. Okay. What do you do? How much do you make?
All right, so for those of you here in the room, if you look into the inside page of your program, there is a Scan Me portion there. You can scan that QR code and it takes you onto a web platform where you submit your questions. In fact, we have one from Thompson, and he's asking a very interesting question. He says, what is the difference between direct and indirect taxes, and can one be used to offset the other?
Okay. So when we talk about direct taxes, we are actually talking about who the incidence of the tax is on. So it comes down to who actually pays the taxes. So if you look at direct taxes, it would usually have to do with what you are making yourself. So if you're an employee, it's on your income. You are making that, so that becomes a direct tax. If you're a business, you are taxed on your profits. That is what you are making. You are suffering the tax yourself. So that is a direct tax. When it comes to indirect taxes, these have to do more with consumption. So it depends on the consumer. Who is consuming that good or the service that your business is providing? So it's really who pays the tax. Yes, in both cases, the company actually does the physical paying of the tax, but it comes down to who actually bears it. Most of the time, generally, in direct cases, it is the company that bears the tax. For indirect taxes, it is the third-party consumer who would pay for it because the company charges. Now, on the question of offsetting, it comes down to when there's an audit. Okay, so you may have a liability on one end and a credit on the other end. The law actually allows, when the Commissioner General is satisfied that there is a credit in one type of tax, to be offset against the other. But during your day-to-day business, you can't get up and say yourself that I have withholding tax credit certificates of 100,000.
So I'm offsetting at source.
No, you cannot. You cannot offset at source. That, unfortunately, is not allowed currently.
Right. All right. Thanks very much. George, I've saved this question for you because quite a lot of the time you hear how there's a big talk about digitizing our economy. How do you see us catching up with the rest of Africa, if not the rest of the world? And what can we do to use digitization to minimize the burden of tax compliance?
Thank you once again. Talking about digitalization, we've experienced where, as a country, we've made a lot of investment in that direction, where all of us know at the ports we have a paperless system, and we also are aware that the GRA has this e-portal, which, all things being equal, should be relieving most taxpayers from some of these challenges we have as taxpayers. Incidentally, the e-portal is functional, but only in a very limited way. Currently, you can do some filing and you can effect some payment. It actually causes some delay. The GRA themselves are not excited about how it's performing. However, they are committed to ensuring that this e-portal will work effectively. We are looking at a situation where we could get to the centralization of the system nationwide, where all systems and procedures would be working effectively and efficiently, such that you can do your e-filing and effect your e-payments, request for a TCC, look at your balance, look at your position on withholding taxes and everything.
What's a TCC? Sorry, I just...
Tax clearance certificate.
Okay.
Actually, the law looks at a situation where you use the electronic system to apply for a tax clearance certificate.
Wow.
And then it will be issued appropriately. So those are not functioning at the moment, but that is where I think at the end of the day, we are all looking to get into. Should we be able to get there, then on a nationwide basis, irrespective of where you were, in the convenience of your room, you can do your filing and effect your payments. And that would save us a lot of cost in terms of making payments, in terms of compliance. Because at the end of the day, what we have by way of dispute, at times even is on the date you made a filing. Once you're using the e-portal, once you click the button, it registers the transaction, and it becomes an undisputed basis between you and the GRA as to when you did your filing.
But I'm a small business or medium-sized business. I've always kept my books. Everything is written on paper. I have receipts and all of these things. What do you feel that businesses ought to start doing so that there's some seamless connectivity to the digitization of tax administration?
Okay. I think if the e-portal should work the way it shouldn't be too difficult for taxpayers to set up their own system and then be able to link up with the e-portal to do whatever they want to do in terms of transactions with the GRA. However, I also believe that the GRA, if you look at the cardinal principles of taxation, you're talking about convenience. If somebody hasn't gotten the financial muscle to make an investment in a technology to be able to link up with your system to make it convenient for the person to comply, why doesn't the system or the regulator make that investment to make it quite easy and convenient for anybody, whether you have the resources as a business entity or not, to be able to do what is expected of you?
Okay, so I'm going to go that room full of people who have lots of questions. We've got a few coming by way of our portal. But before I come back to that, I'd like to go across the room. Is there anyone who has a question? Just put your hand up. We'll get a microphone over to you, and keep it concise, and we'll get some answers for you. Any kind of tax. But, you know, in your explanation of the transfer pricing, so sometimes, you know, we think ingenious ways of doing things, and then sometimes people also find disingenuous ways of doing things. Your explanation was how to ensure that it works well, so your business is efficient where there's related party transactions. Is it something that someone can try and be disingenuous to get around taxation by just passing business from one of their in the group or the other, just so that they minimize their exposure?
Well, thank you. When we're talking about transfer pricing, it's not necessarily between the entities. Under our law, transactions in between the employer and the employee is also a transfer pricing subject. If we look at Uncle Joe, he has 87 employees.
Yes.
And that triggers a transfer pricing issue for him, especially the so-called partners, as to whether they are business partners or they were service providers. His relationship with them and all those stuff also triggers a TP issue for him. In fact, between himself and the entities he set up also triggers a TP, a transfer pricing issue, just because, for instance, he can look at his personal tax rate, calculate how much taxes he can pay as an individual depending on the earnings he considers for himself, and then passes it as a salary cost to an entity which is making profits but has a higher tax rate. For instance, if somebody is in mining and the corporate tax rate in mining is 35%, now the PAYE rate has come to 30%. It makes a lot of sense for me to pay myself well and pay the highest tax rate of 30% than to pay myself less and then charge it as salary and then create more corporate tax as a mining entity and pay at 35. So if you do things like that, then the law would now want to examine whether the amount you pay yourself as an executive, is it at arm's length? If it's not at arm's length, then the CGE can make adjustments to...
Wow, that's interesting. Do we have a question from the floor? All right, there's three. Wonderful. We'll take those three questions. And if you're listening to Joy FM, this is IntelliTax. It's a conversation about paying your taxes intelligently, and inspired by PwC. It's the first in the series of the Joy Business Knowledge Series, and we hope we're empowering you. Let me go to tell us your name and then your company or where you're coming from, and then quickly go into the question.
Okay. Good morning. Deborah. I've started a sole proprietor business, which is into...
Okay, I think we have a problem with that microphone. While we resolve that, there's a question on our portal which says, what are the kinds of taxes NGOs are supposed to pay? And either one of you can take this. And why are they exempt? What are they exempted from? So is there a specific kind of tax that NGOs have to pay? And are there any exemptions?
So, yeah, I can take that. So, NGOs, there's something interesting about taxes. Sometimes you can coin things your own way and have your definition. But if you come to the tax law, it may have its own definition of what it sees as maybe, in quotes, your NGO or people that are exempt from taxes. So I want us to get that clear. You may have something you are doing as an NGO. Under the tax law, we have some specific kind of non-profit organizations that are, one, exempted from taxes or need to meet some conditions to be exempted from taxes. So we have generally, let's say, for example, charitable organizations or religious institutions. That has been a topical issue for some time now. For some kinds of institutions like that, like those who are into rural development, those who are into religious institutions, or general activities of public nature, you are not profit-making. There's an opportunity for that income from that side of your activity not to be subject to taxes. If you have any kind of business alongside, let's say you have a church that has maybe a bookshop or that sells maybe, let's say, anointing oil, something that makes you make profit out of some side of that income, we would say, look at it. Or you have a restaurant business, you have a school, a private that you are not plowing back. We'll say that is not part of your not-for-profit activity, so you should pay taxes. But if we come to the side that has to do with you not paying taxes, there are also a condition for some specific ones to go to the Commissioner General. You have some conditions you have to meet. One, you don't have to have some political intentions, or you have to have been set up or doing what you've been set up to do. And if you meet those, you have to apply to the Commissioner General that these are I meet all this criteria and for public purposes, so issue me an approval to be seen as a charitable organization. And if he gives you that piece of paper or that permission, then that means you can actually be exempt from taxes. So I think the point here is that don't be too comfortable that you think you are doing something that's not for profit, so you are exempt from tax. It's not every category that is just blankets. For most of them, you may have to go to the Commissioner General for an approval, on which basis people will not have to withhold on you, because withholding taxes are for those who would be subject to taxes. So if you are exempt, then you don't have any taxes to pay, based on which you should be withheld on upfront. So that is in terms of the general taxes, that's the bit on NGOs.
Okay. So I think we've fixed the mic situation. Good morning.
So I'm Deborah. I started on interior design.
Okay, I thought we had fixed this. All right, let me just come to you.
Thank you. I'm Deborah. Good morning. I've started an interior design business, and some of the things that we do is to take on projects. So I wanted to know that in paying service providers on behalf of the clients that I'm handling their projects, am I supposed to deduct withholding taxes? Because I know the ones that benefit my business directly, I do. But for the one that goes to the client, since I'm paying on his behalf, am I supposed to deduct withholding taxes?
Interesting question.
Okay. So that was another direct tax area. But are you supposed to withhold, because you are more like an intermediary, right? If I get your question right. You are doing something on behalf of somebody. And so you are raising, how's the invoices? Two things. So our tax law, unfortunately, for some advanced countries, they make room for what we call disbursement or reimbursement. And generally, for some countries I'm aware of, when you meet those criteria, generally you're not supposed to withhold. We don't have any special regime like that in our tax laws. So practically, what happens is that it depends on how you have arranged or structured the transaction and what the substance is. So if you are moving, you have to invoice the client. So you invoice somebody, you are doing something on behalf of somebody. So how do you cascade the invoice down? Do you raise your invoice to the customer or the person you are doing on behalf with, and then now you surcharge that cost? Because ideally, if you are merely an agent of that person, then the transaction and the form and the invoicing and everything should be seen as between the principal and that client or the third parties. So one condition, that is practical, as I was saying, the tax law does not specifically address it. But if you really want to hold yourself up high as an agent for sure or truly, then what will happen is that I expect the invoicing to be directly between the third party and your client. So that when GRA comes to you for an audit, they would see that the invoice is not in your name. It's not that you take the invoice in your name and now pass on the cost to the other person. Because pricing is your own, you can take advantage of the situation, or you can choose how to price your service. So let's say like PwC, we can say the price that we give you is staff cost plus markup. Somebody can argue it that way. For some people, they won't break it down that way. So if I do that and say that I'm passing on the staff cost to you, so you won't withhold on the staff cost, then that means you may be cheating the system. So far as the invoicing is in your name and you then pass it on, it's seen as you rendering a service because you can't prove that that is not your true cost. One, if it's really not your true cost, we expect that it will not go through your income statement at all. It's purely something that you are funding in advance. So these are some of the practical things on how to go. Strictly by law, we don't have anything that addresses reimbursement. You should be withholding. But if you want to hold yourself up as substance, these are some of the practical issues you can point out and appeal to the GRA that, do you know what, I'm a mere intermediary. I have no part to play in this. Invoices are between these two people, and I'm just getting maybe a commissions or some fees for what I am rendering. And for that, I'm paying taxes and withholding on everything.
Okay, we're going to take a round of questions, so please note them down, and then we'll take the answers in a batch. I'll come to you first.
My name is Teresa Minta, and I'm into the fashion industry. My question goes to you. You mentioned, you said something about the young entrepreneur regime. And in your statement, I heard you saying people who are more than 35. I want you to confirm that. Is it less than 35 years or more than 35 years? And which type of businesses qualify? Is it sole proprietorship, limited liability companies, etc.?
Okay.
Good morning. My name is Aisha, and I'm with Ikra Educational Center. Earlier in the presentation about Uncle John, it was mentioned that not all employees are expected to be on payroll or deserve to be on payroll. Could you please elaborate further? Let us know what are the things you should consider as an employer to put someone on payroll or not. Thank you.
Thank you. And the gentleman right, second, front row.
Thank you. Thank you. I'm Engineer Magnus Esidu from Ghana Consulting Engineers Association. We find the taxmen or taxwomen and the tax law not in consonance with our practices. You find that the tax law, the taxman comes as a zombie policeman coming to look at your books and says that, look, you are not paying taxes. And the taxmen will not look at the practices, will not look at it, say, well, if this is your income, you have to pay tax on it. And you tell the taxman that, look, this is my income, but the base of my income, I'm a sub-consultant to a main consultant. The main consultant has invoiced, and out of our invoices, the VAT has been paid. He says that, well, your income is there, so, and as far as the tax law is concerned, once you have your income, VAT must be paid. So, it is important that the tax law itself should know exactly what goes on in our businesses. It's like Uncle John. I'm sure, what's the name? Consultant GJJ. When he was in his when he was in court as a nephew, understood him, but when he immediately puts on his coat as a consultant, becomes a problem. The issue is, I think that the taxmen and the tax law must not just follow things because, well, you are taught in school as accountants and things, and businesses have been couched after Britain and America and all that. Let's remember that they have evolved. We are also evolving. So the taxman must be as practical as possible. Look at what is exactly going on. Don't assume that we want to evade tax. No. just look at the steps. A main invoice has been done. I've been paid out of the invoice. That main invoice had deducted VAT. Why should I pay the VAT again?
Okay, so that clearly there's an issue there. So we're going to take one final question and then we'll go another round. The second row, first. I can see two, one at the back, one in the middle. Okay, three on this side and then one here. That will be for the next round. So please ask your question.
Good morning. My name is Fatima. I'm the chairperson of the agri sector at the Association of Ghana Industries. For me, it's pretty simple questions, but not sure in terms of clarity. First and foremost, obviously with the rules with associations, and that is you tend to get to be pulled into various boards. You could be sitting on a cotton board authority, you could be sitting on something else. How does that work in terms of taxes as an individual representing an association? And my second question then comes into the new introduction of the point of sale for VAT, which is supposed to be coming in for the sector in terms of retail trade and all that. How does that work? Is it going to be tied in only to retail? Does wholesale become a part of it? Or is it the whole value chain that will be a mandatory in terms of using the point of sale for VAT tax?
Thank you very much. So we'll pause with the questions for now and take some answers. If you just tuned in, this is the Joy Business Knowledge Series coming to you live from the Mövenpick Ambassador Hotel in Accra, and it's powered by PwC. Our focus is on IntelliTax, helping you pay your taxes intelligently. You can follow the conversation by sending your tweets with the hashtag IntelliTax. And we're now doing some Q&A, so stay tuned and be informed. So who's going to start with the answers? I know a variety of questions have been asked. Who's going to start us off? I think there's a couple that were directed at Gifty at the very end, so we can start with you, Gifty.
Okay, so I'll take the first one on the young entrepreneur. I'm sorry if I said more than 35, it has to be 35 or less, sorry. So you have to be 35 years old or younger to be able to benefit from it. And with respect to which industries, there's something we normally would call strategic industries. It includes quite a long list, but examples are ICT, agro-processing, manufacturing, tourism. And so those are all the kind of areas or industries that you have to be involved in to be able to get that. Okay, so that's an interesting one. As the law stands now, it said resident individuals of 35 years or younger age. So it's a kind, if we are doing strict interpretation of the law, it comes across as if it has to be an individual. You should be operating on your own, more of sole proprietorship and not really through a business. But from what we know or what we expect or what we thought was intent of the law, we think it's actually supposed to relieve such kind of businesses. So we are yet to we haven't seen that kind of provision in full swing or applied yet to see what to actually apply in practice. If the intent of the law will be applied, where even if you have registered a business to do that same business and you are younger than 35 as, let's say, the sole shareholder, if that same thing will apply. If you ask me, I'll say yes, it should, but the law, it could vary depending on how you interpret the law. Somebody will also ask, what if it's two people who have set up that business to do that? One is more than 35, one is less than 35. You get, so there could be complications around it.
Let's allow the other questions to be answered. We'll come round for another round and then just note it down so we can get some of the other questions answered in a moment. And there'll be lots of opportunities when we go off air and we're going into the networking session. If there's something you need further clarity on, you may be